Hi there everybody, and welcome back to another stock analysis video. Today we are going to be analyzing the company Johnson & Johnson. Now this one and Merck was actually brought up by a commenter named Elizabeth Shelbourne, where she has been trying to find out what kind of good pharmaceutical companies there are out there to buy right now that are at a fairly good price. So I'm going to try to help her out the best of my ability, and I'm going to try to do as many pharmaceutical companies as possible. Now I've done AbbVie, I've done Eli Lilly, and now I'm going to do Johnson & Johnson, and next will absolutely be Merck. So let's actually analyze this company, guys, to see if maybe at the current share price we would like to buy it. So with that said, let's get started with this analysis. Now before we actually get started into pretty much any fundamentals or any financials, I actually have to point out something that I haven't been doing for the other pharma companies, though something that you guys should definitely do regardless when it comes to the pharma sector, and that is that you guys should definitely take a look at the pharmaceutical pipeline for some of these companies, especially for the drug manufacturers, because, well, when they make a drug that is very prominent, usually they have that patent for a certain amount of time. And definitely something that all of you guys should find out is, first of all, when that patent expires, number one, which that could be easily done by a quick Google search. And the second thing is, guys, is take a look at what drugs they actually have in their pipeline and what phase they're currently in. So I'm actually showing you guys right here Johnson & Johnson's pharmaceutical pipeline. As you can see, there's a lot of them, right? There are several for like neuroscience, they have oncology, they have immunology, infectious, cardiovascular, etc. So this is something that you guys should definitely take a look at and see which phase their current drugs are in, because if they're prominent ones which are currently in the market are about to go out of patent and the generic drugs get to actually come into the market, meaning more competition, this would definitely drive prices down. So definitely something to take a look at is which of the new drugs that they have in the pipeline is currently in which phase. So I'm actually going to leave this link that you guys are seeing right here in the description below, just so that way you can see. And on top of that, when it comes to any other pharma company that anybody may want to find out, all you really have to do is just type in on Google the name of the company and then pipeline, and then that should be like the first or second search that pops up. So just to let you know that when it comes to this, guys, definitely take a look at which drugs they actually have coming out and in what phase they are currently in. Alright, now let's come over here to the dividend summary, guys. Johnson & Johnson is a prominent dividend king, believe it or not, and this is actually one that is in a lot of people's portfolio. Current dividend yield of 2.64%, which ends up being $1.13 per share for an annual payout of $4.52, so it's actually not too shabby right now. Payout ratio, not in regards to the free cash flow, we'll take a look at that later, but nonetheless, the payout ratio is around 43.14%. Fairly low. The 5-year CAGR is, could be a little bit better at 5.87. However, what is amazing, guys, is this dividend growth of 59 consecutive years. A company that has been paying a dividend consecutively for more than 50 years, it is considered a dividend king. Anything above 25, it is a dividend aristocrat. Now, I don't know if there's any companies that are out there that have it over 100 years. I don't think there's any, but if we ever reach that, I have a pretty good idea of what to call it, but maybe one day we'll see that terminology come up. Ex-dividend date passed as of May 23rd, payout date was on June 7th, and they pay their dividends quarterly. Coming now into the calculator, guys, we got the ticker symbol of JNJ, market cap of almost $450 billion with a PE of 24.88. So I personally like to buy anything under 20. That is just my personal choice, and with a current share price of $171, this pretty much is telling me that, well, they actually may be a little bit expensive. Now, coming over here, we actually see that they recently just had earnings as of July 19th, where they actually beat on EPS normalized actual by 4 cents. However, their gap missed by 39 cents, but the revenue actually came in at a beat by $195.47 million. So it's actually fairly interesting about what's happening with Johnson & Johnson at the current moment when it comes to their earnings. And in fact, looking at the 52-week range, we could see that the lowest that they've been, guys, has been $155.72, and the highest was $186.69. So at the current share price, we don't necessarily know if this is actually a good price. Obviously, to the PE, it is not, but PE doesn't necessarily mean much. We're gonna take a look at other metrics. discounted free cash flow, project that into the future and see what we actually get. Now looking at this dividend, guys, of $4.52. In regards to the amount of shares outstanding that they have, well, they actually pay out almost $12 billion in dividends every single year, which is a lot, right? That's a lot, guys. But if we take a look at the 5-year average free cash flow, and then we subtract the 5-year average free cash flow minus this $12 billion or so, we get that they're still left with around $7.35 billion left in their 5-year average. And if we do the same math with their last year's free cash flow, we get around $7.9 billion, which actually comes out to be, guys, a payout ratios of 60.14% for the last year's free cash flow, and in the 5-year it is 61.78. So it is just above my mark of 60% as to what I consider affordable. So it's not too bad, but it's, you know, I would like it to be just a little bit lower, but it's okay, I guess you could say. Now let's come over here to some fundamentals, starting of course with the net income of 5 years ago of $1.3 billion to 1 year ago, guys, of $20.8 billion. That is a massive increase of 1,506%. Absolutely insane. Now, obviously, the big elephant here is that 5 years ago, they barely did $1.3 billion in their net income. From 5 years ago to 4 years ago, they shot up from 1.3 to 15.3, an increase of 5 times. That is absolutely insane, which is a massive increase. And then what's also very, very peculiar is that from 4 to 2 years ago, they were around the same value of 15.3 billion to 15.1 to then 14.7, and then 1 year ago, boom, shot up to $20.8 billion. Guys, I don't necessarily know where to put this, right? Because sure, it is increasing, I guess you could say. It is positive, but it's not consistently increasing. So I'm actually gonna give this a fairly low score of around 60%, just because of the fact that it's not consistently increasing and this stagnant net income over here isn't doing it justice. Coming now to the free cash flow, the most important of all the profit metrics, because guys, this is what the company uses to essentially operate. They use this to pay out the dividend, which they pay out the dividend, a massive one at that, for 59 consecutive years. They buy back shares, they pay down debt, they make acquisitions, which Johnson & Johnson, I mean, it's one of the biggest pharma companies out there. Pretty sure they make a lot of acquisitions, and they overall grow the company by making new and better drugs. So it's very, very important for the cash flow to be positive as well as increasing. Now, I'm kind of sad to say that while it is increasing, it could be a lot better. 5 years ago of $17.8 billion to 1 year ago, guys, of $19.7 billion. Now that is an increase of 11%, with an average 5-year free cash flow of $19 billion. Now the reason why I'm saying this could be a little bit better is because of the fact that it's pretty stagnant, right? As of what, 3 years ago to 1 year ago, it remained around like the $19 billion, $20 billion mark. It didn't really grow much, unfortunately, but it is what it is. And, you know, I wish I could say that it is consistently increasing. And I mean, it is, but it really isn't, right? So overall, I'm actually gonna give this, guys, a score of around 70%, just because it's about average, right? It's not too bad and it's not too good. It's just average. Now looking at the revenue, 5 years ago of $76.45 billion to look at this, guys. 1 year ago of $93.8 billion. Massive, massive increase of 22.66%. Now, the reason why I'm saying massive is because Johnson & Johnson is a massive company. I know I just said massive like 5 times, but nonetheless, it is a pretty big company. And the bigger the company is, the harder it is for them to actually grow. So it's actually fairly surprising for a company this size to go from 76 billion to 93 billion in just a couple of years. Now, obviously, we can attribute this to a lot of things. For starters, the COVID vaccine, right? The Johnson & Johnson COVID vaccine. I think that's mainly where this is coming from. A lot of emergency FDA processes essentially got stripped during this time because people were just like, we need a vaccine now. So I think that's essentially what's causing this $93.7 billion. But as you can see, it's not far off from what they were 2 years ago and even 3 years ago. Now, what is concerning is that we didn't see much of an increase from 3 years ago to 2 years ago. So we don't necessarily see a big increase from 3 years ago to 2 years ago, but nonetheless, it is still an increase. And well, $93.7 billion, I think they'll be able to do this again in the next coming years. I don't see this being so much of an outlier. So overall, I'm actually going to give this a fairly decent score of around 85%. Now let's analyze some balance sheet numbers in total assets minus the total liabilities. Will this company survive an economic downturn if the economy were to go on a tailspin? Well, you essentially want their liabilities to be under their assets, and hopefully for their assets to continue increasing and their liabilities to decrease, so that way this number gets bigger and bigger and bigger. As it currently stands, they're at $76.4 billion in this difference, and on top of that, they have been increasing within the past 5 years. However, not consistently. If you take a look at this, 5 years ago they were at $60 billion, 4 years ago $59.7 billion, 3 years ago $59.4 billion, and then 2 years ago $63.3 billion. So from 5 to 3 years ago, it was going down, but then it did go up significantly. Overall, that's actually not too bad. If we take a look at the average total assets, we get around $167 billion. Average liabilities, we get around $101.6 billion. And doing this difference, we get $65.5 billion. Overall, guys, I have to give this a pretty good score. Not a perfect score, mainly because we did see 3 years of this value coming down, but I think it does deserve at around like an 85% or so, maybe even a 90%. But just because the assets can't cover their liabilities doesn't necessarily mean that their cash flow can. As I said, cash flow is what companies use to pay down their debt. So very, very important for the cash flow to be superseding their liabilities, or at least their cash flow and liabilities going in the opposite direction. The liabilities decreasing, cash flow increasing, essentially making the difference closer and closer to zero, if not positive, ideally. As it currently stands, guys, well, they are going further and further in the red, currently at negative $88 billion. And this is a decrease by around $10 billion or so within the past 5 years. However, we did see the peak at two years ago at $91.47 billion, probably because of COVID, right? So that's perfectly understandable. They are bringing it back, but as you can see, they've been around like the 78, 79, 75, 77 billion dollar mark within the past 5, 4, and 3 years ago. So, you know, take that with a grain of salt. Average cash flow minus the average liabilities, we get around negative $82 billion. Overall, I actually have to give this a failing score, but it's not too bad, I guess you could say, right? I'm gonna give this at around 50% just because it is going down, but it could be a lot worse too. And now looking at the shares outstanding, the metric that people tend to overlook, and it's a really, really underrated metric, but in this channel, we cover it. I don't care. We're covering it every single time we analyze a company, because this tells you if the company is diluting you as the investor by issuing shares. You want a company to be buying back shares, not just because of the fact that they're increasing your ownership of the company, but if you own the company for a dividend and they're buying back shares, well, this actually means that their payout ratio is actually decreasing as well, because the less shares that there are out there to buy, well, the company doesn't need to pay out that dividend anymore. They're not going to pay themselves the dividend. They just don't pay it at all, right? So they're actually saving on cash flow by buying back shares in the long span of time. So it's actually really, really good for this number to be coming down. And when it comes to Johnson & Johnson, it is coming down. 5 years ago of 2.7 billion shares to today, guys, of 2.6 billion shares. Now, that is a decrease on the 5 year of around 2%. Not too big, but it is still a decrease nonetheless. And from the previous year to the current year, they bought back at around 0.13%. So I wish this was a little bit more aggressive, but overall it is still in the positive direction. So I'm going to give this, guys, a fairly good score at around like a 90%. Wish it could be higher, but they're not buying aggressively enough. And lastly, looking at the cash equivalents, they currently have almost $11 billion on hand with an average cash of around $15.4 billion. So let us come over here and do a quick recap. Net income 60%, free cash flow 70%, revenue 85%, assets minus liabilities 90%, cash flow minus liabilities 50%, shares outstanding 90% for an overall grade, guys, of 74%. So it's a pretty average company in my personal opinion when it comes to their current fundamentals. But let's now go into the discounted free cash flow to see if maybe with the current share price of 171, we would like to buy it today. So let's make some assumptions, low, median, high, using 3 different factors: revenue growth, the predicted share buyback, and of course the required rate of return, which I like to keep flat at 10% to match the S&P 500. For the revenue growth, guys, let's come over here to Seeking Alpha and see that the revenue growth forward is at 6.26% and the revenue growth year over year has been 7.17%. So my job as an investor is to be essentially conservative when it comes to these values. Do I believe that they'll grow at this much in the next coming years? Well, it really just depends, right? Because we did have a massive outlier year in 2020 because of COVID, and their vaccine really did bring up their profits. However, seeing that this is now dying down, they may actually lose a little bit of their profits in the next upcoming years. And on top of that, guys, we may actually see this revenue growth come down because of the fact that Johnson & Johnson is one of the biggest pharma companies out there in the world, right? So the bigger a company is, the harder it is for them to get larger and larger and larger, unless you're Apple. They're the only outlier. But Johnson & Johnson, the rate of growth will probably slow down. So for the revenue growth, I'm going to say that for the low assumption that they'll grow at around 3%. For the median assumption, let's say around 4%. And for the highest assumption, let's say around 5%. So it's actually still under the revenue growth forward, but I think it's still fairly conservative enough that I feel comfortable with these revenue growths, especially drugs coming out of patents. Now for the predicted share buyback. Well, they've actually bought back at around 2% of shares within the past 5 years or so. I'm going to take this into account and say that within the next couple of years, let's say that they'll buy back shares at 1%. For the median assumption, let's say 2%, which is on par with what they're doing right now. And let's say for the highest assumption, 3%, which is more than what they're doing right now. And we get some target share prices now that we have inputted these numbers. For the low assumption, we get $151 essentially, right? We're at $150.98, $151. For the median assumption, we get $157.93. And for the high assumption, we get $165.16. Now adjusting for debt, we take the cash equivalents, we add the net debt. If they have more debt than cash, the value comes down. And if they have more cash than debt, then the value comes up. So you can see it does come up by around $4 or so to $155.19 for the low assumption, $162.18 for the median assumption, and $169.45 for the highest assumption. Now adding a margin of safety on top of this, we get between the ranges of $132 or about there to $147.43 for the low assumption. For the median assumption, it is $137.85 to $154.07. And for the high assumption, we get $144 to $161. Guys, the current share price is $171. So in every single scenario, based off of my assumptions, this is still saying that we may want to wait. However, now it's a time that you need to take into account the size of the company, right? Because when you buy a share of a company, you are buying a piece of that company. So now my question to all of you is, especially you, Elizabeth, is Johnson & Johnson is one of the biggest companies out there, even with the several amount of scandals that they've had with like the baby powder and asbestos, stuff that has been happening. They're still making money year over year, especially in that revenue. So now the question is, if you believe my assumptions, let's say you believe the medium one, do you think that you are willing to pay that extra premium of around $10 for the target share prices after debt, or the $13 for the target share prices not adjusting for debt, assuming that they'll actually grow at 4% in the next 4 years, as well as buy the same amount of shares back? So again, it really just depends as to what you believe and if you're willing to pay that premium. So I personally, in my opinion, Johnson & Johnson, I would personally take that L, right? I would personally pay that premium because it is Johnson & Johnson. It's just like saying, if I put Apple at a share price of $100 and it's at $105, I mean, come on, like, what's $5, right? It's okay to pay that premium because of the fact that they are that big of a company. At least it's just my personal opinion. So it really just depends on to what you guys think. And as I always say in every single video, every investment is the present value of all future cash flow. That's why I have this calculator, guys, available for free, so that way you guys can make your own assumptions, because this is not financial advice. Every single number that you see here was based off of my assumptions over here, even the required rate of return. If you change this required rate of return, these numbers will change drastically as well, even the margins of safety. So I highly encourage everybody to have this calculator. It's available for free, as well as my book value calculators, my reevaluation calculator, and a dividend tracking sheet. I actually have over here this company which I actually hold, and they currently pay me around $2.32 in quarterly dividends. Don't have a lot of shares, but nonetheless, I still own a little bit of them. So I highly encourage everybody to have these calculators and make your own assumptions. Again, not financial advice. All I'm asking for in return is just like, subscribe, comment, help me grow my channel. Thank you so much, everybody. I just cannot believe 800 subscribers. That is insane. 800 subscribers. As I'm making this video, it's at 810. My goodness, I just cannot. Thank you so much for everybody who has helped me just by giving that click, like, subscribe, comment. You know, it really does help. Thank you so much. Hopefully we can get to 1,000 soon, because I do have a really good video planned out for then. So the faster we get to 1,000, the faster you guys get that video. All in all, thank you so much. And thank you everybody for the support. Now let's actually analyze Johnson & Johnson when it comes to a dividend, because I own this company for its dividend. I gotta be honest with you. This dividend, 59 consecutive years, is amazing, right? They've been through a recession. They've been through a pandemic. They've been through a dot-com bubble. They've been through pretty much everything at this point, and they're still issuing that dividend and still making money. So really, really good, solid dividend right here. So let's say that you make the average US income at $5,725, which is the monthly income, and we want to buy 1 month's income of this company at the current share price. Well, this would buy us 33.46 shares, and at the current share price, this actually gets us, guys, $151.24 annually, quarterly dividends of $37.81, and a monthly dividend of $12.60. So it's actually not too shabby. I personally like to buy anything above 200 for 5,725, but then again, the target share prices are fairly close to the current share price, so you know, you may want to buy this company not just for its dividend obviously, but also for everything else that they bring into the table as well when it comes to the predicted share buyback, the revenue, and the free cash flow. All in all, guys, Johnson & Johnson is a company that I actually own. I just showed all of you guys. I own about 2 shares. That's about it. But hopefully in the future, I get a chance to buy more of it. I personally like it. And even with all the scandals that they've had, they're still making money. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help it with the algorithm on YouTube. As I said, you guys can follow me on my new tech sites. Link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video.